Now let's talk about valuations here. So the company Hungry Head here is asking for 5 million or 50 lakhs for 5% equity.
मैगी के साथ क्या उखाड़ लिया?
Let's assume founders have all the shares before this investments. So if they are asking for 5 million for 5% equity, it means 100% of their equity is worth 100 million. That is, they're valuing their company at 100 million. Now it's important to understand that valuation is a post-money valuation. Now what is a post-money valuation? Post-money valuation is basically just the pre-money valuation plus any cash injection from the investors. Say your company is worth 1 million before any investments. If an investor offer you 1 million, he would not get the whole company. He would not get 100% of the shares of the company, because after his cash injection, the company now it was 2 million. So his share would just be 1 million divided by 2 million, that is 50%. That is basically his investments divided by the post-money valuation. Similarly, in the case of Hungry Head, they are asking for 5 million for 5% equity, making their post-money valuation to be worth 100 million. Now, what would be the pre-money valuation in this case? It would just be post-money valuation of 100 million minus the cash injection of 5 million equal to 95 million. Now, founders here thinks that their company is worth 95 million right now. Now, that is a very wrong assumption. It would certainly be a very bad deal if investors had invested in this company. Now, why I'm saying that? Let's see. The company here mentioned that their average monthly sales have been around 5 lakh to 6 lakh, 500k to 600k, which makes their annual sale figures to be around 6 million to 7 million. Now, even if we take just the sales in the valuation, which is not right though, it would still take them around 15 years to reach 95 million mark. Basically what they're valuing their company right now. I haven't discounted the sales yet for inflation. Assume their business growth is around the inflation, which is around 6 to 7%. But what really matters in the valuation is the earnings and the positive cash flows. Now in a restaurant business, you have a high fixed expenses. You have to pay for space, rent, chefs, helpers, utilities, even if you don't have any sales. On top of that, you have the variable expenses such as raw food, deliveries, etc. Let's assume the net margin of around 10 to 15%. Even if a restaurant is operating at a high operating efficiency, it would be around 20% at max. Let's take 20% net earnings on top of 5 to 6 million sales. Their annual earning is going to be around 1.5 million, 2 million, and thus it would take them around more than 50 years to reach to that 100 million valuation mark. You can also look at the multiples they are asking for. With the earnings of around 2 million per year and a post-money valuation of 100 million, they'll be trading at a PE multiple of 50, which is extremely high even for a growth company, let alone a restaurant business. Take an example of Apple. Apple is trading at a PE multiple of 28. Netflix is trading at a PE multiple of 35. Amazon is trading at a PE multiple of 50. Now you can compare the businesses of Amazon and all these companies, although they are not in the same sector, but growth companies usually have high PE multiples. Take an example of a company in the same sector such as Domino's. Now Domino's is trading at a PE multiple of 28. Despite the global brand chain, global presence, it's still trading at a PE multiple of 28. In such a case, asking for a PE multiple of 50 for a Maggie business is ridiculous. Naturally, investor backed out of the deal.
Thank you, sir. But sir, एक बार food try कर लीजिए.
Now this brings us to the end of this video. If you like this video, if you like the content, we can go in depth in the valuation in further videos. If you think this video was helpful, please hit that like button, subscribe the channel and share it with your friends. I'll see you in the next one.